You're in the Business Insurance Zone with me, Steve Savant, National Insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series 3, the tax items. And on today's show, Section 162 Executive Bonus Arrangement with National Financial columnist and CPA Ken Davis.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, and we're broadcasting live to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And today, of course, with me, day 4, Mr. CLU, CHFC, CFP, and CPA Ken Davis.
Hey, Stephen. Good to see you again.
Welcome back. And boy, I tell you what, if you missed the first 3 shows, you're going to say, Steve, I did not realize all the cool things. I mean, I realize life insurance has an income. Everybody's watching our show knows that. But what we're talking about now is adding a new element this week. Man, I could actually use some of my arbitrage loans year 1 to reimburse myself because I don't get a deduction. So I want to give a little bit of a balance sheet equivalent if I can. I don't know if I like that phrase or term, but to at least reimburse myself. And because I want my income to come out tax-free via loans and withdrawals to basis, keeping the policy loan I got to say all this just to cover myself, to keep the policy loan in force for the life of the insured. And on top of that, I want to be able to not injure my ability to take Social Security out and get it taxed. I don't know if I'll be successful, Ken, but that's our goal.
Well, let me add too that you need a good IMO like Brokers Alliance to squeeze down the cost of the contract so that in fact we can actually grow the cash value at the levels that we're talking about and make this thing work, because without that the cost could eat up the contract. That's
right, and we really manage this here, and our sponsor's great at that, and they have their illustrators and proposal people are just excellent at it. I want to talk today about a business slant on this because, generally we've been talking about non-ERISA, most a personal retirement plan. Now we're talking about using the traditional, very easy to understand, Section 162. If you are saying, Steve, this is new to me, just say when you write me at thebiz@brokersalliance.com, I'll send you a basic doc that'll explain everything about 162, and it's excellent. But part of our package today is we're giving away a much more sophisticated turnkey package that includes everything we're going to talk about. Ken, give us the entry level into 162 bonus.
Well, 162 is actually just an Internal Revenue Code section that allows an employer to deduct compensation to an employee. That's where the term comes from. And basically what's been done for many, many years, this is plain vanilla stuff that's now being revved up a little bit with some new ideas. But basically, you're my employee and I say, Steve, I love you, I want you to hang around. I'm going to put $10,000 away each year into a life contract that's going to be yours. And you go, wow, that's great. And I said, the bad news, Steve, is I get a deduction at the company level. However, you're going to have to take this into income. He said, well, gosh, that's not like a qualified plan, is it? And I said, no, it's not. However, you'll get tax deferral in between and then tax-free income at retirement. But even better.
And you own it and you could walk.
That's right. And so, but you know what, to make this even better, Steve, I'm going to give you a cash bonus sufficient to cover the taxes on the premium bonus and then the taxes on the cash bonus itself. It's one of these crazy iterative types of calculations.
Is that like looking into a mirror that goes into eternity because you have multiple tax? Yeah.
That's a really good image. That says it very well.
Well, let's just talk about it because you've said 2 things. One is traditional 162. I do have to pay the tax on it as I'm receiving it as the executive, and I like that, but I have to pay the taxes. Okay, fine. Right. But it is my policy. I could walk from the contract. I could get other cash values from it if I wanted to.
Right.
The second one was, my employer is going to step up and not only give me a bonus to put into my life insurance contract, he's going to give me the tax I have to pay on that bonus. Okay, I like that.
Well, and let's look at it from the corporate standpoint. It works for them too, because let's say I pay $10,000 plus another $6,000 in cash to pay taxes. That's 16 grand out of my pocket as a company owner. But I get a deduction for that. And let's say I'm a C Corp, I'm in a high tax bracket, and so when I take a deduction for that, I pretty much get back that extra bonus, and my net becomes close to that $10,000. So on a cash flow after tax basis, it actually looks better than the 16 grand.
When I think about it, I want to add another iteration to this, okay? So we've talked about single, just plain old Section 162 bonus. Then we said, oh, the employer is going to pay the bonus in 162 double bonus because he's paying the premium and the tax on the premium. Ken, talk a little bit about, and I don't want to name any carriers or their acronyms if we can get away with it, okay? And the temptation here is huge. But let's talk about a 162 double bonus with a restrictive cash value endorsement and a separate and not related employee agreement.
Yeah, and basically we're stepping into some technical area that it's important that accountants and attorneys are involved in, especially the drafting of the document to make sure it's right, because we don't want to slip into an employer plan that would step into the line of ERISA. So it's relatively easy to stay out of trouble. It's a pretty clean type of deal, but basically we're dealing with top hat employees, and that's kind of a term of art in the tax law. We're talking about executives and people making high income.
So that's a technical term, top hat.
Well, it's not in the code, but it is what advisors use as a concept.
Well, the only reason I smile is because the last time Ken was talking about tax deferral, he said we're going to let it cook. So I was it's like Ken's little vocabulary, you know.
So anyway, what happens is first we put an employee agreement. And Steve, you know, I love you, but I want you to hang around. So I'm going to put all this money up, and I want to know you're going to hang out. I don't want you just skipping out the door and taking all this cash I gave you. So what I'm going to do is I'm going to put some restrictions that if you leave before a certain date, you're going to have to come back and pay me some of that cash back. That's an employer-employee agreement.
So those two docs, a restrictive cash value endorsement and an employment agreement, which don't necessarily relate to each other at all, are two docs. And again, I have the actual restrictive cash value endorsement, and out on the web there's a ton of employment agreements. When we come back from the break, we're going to address the business applications of 162 and tax advantage life insurance. And don't forget, you need to enroll in IULUniversity.com for the best training, education, and sales ideas when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Have you been holding back on submitting your impaired risk case? Now's the time to dig them out of your files in the commission graveyard. Underwriters can be more like undertakers, sleep at the wheel of their hearse and driving your case into a ditch. But at Brokers Alliance, our triage field underwriting team drives your case to our special ICU unit. And because we're driving your case and not the underwriter, we can steer your impaired risk case to the carrier with the expertise specific to your client's impairment. We've separated the underwriters from the undertakers. We know how to breathe life back into your impaired risk case. Diseases don't have to be deal killers. They can be sales opportunities. And don't forget to download the copy of the Impaired Risk Field Guide, the most comprehensive impaired risk report in the industry. Go to www.impairedriskreport.com.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Ken Davis. And remember, you can order today's giveaways at thebiz at brokersalliance.com. And one of the giveaways, of course, is our 1040 overlay, which will help you do a lot of things we're talking about, as well as our marginal tax brackets for 2012, and especially this show of all shows, we're giving away our solar kit, our self-owner life and retirement plan. This is a great turnkey, and especially what we're talking about right now. And remember, before moving forward with any of the ideas on this show, especially this coming segment, always consult your tax advisor and broker-dealer compliance officer. We just talk about taxes. We don't give consultative advice. And in this segment, we're addressing the business applications of 162 and the tax advantages of marrying it to life insurance under this plan. And one of the kits we're giving away, I think it works really great, is this solar idea. Now, when we're talking about a 162 bonus, and I'm using a restrictive endorsement so that I can't just walk. It's a golden handcuff to the employee. I'm using an employment agreement to kind of seeing we've agreed on a basic arrangement, employee arrangement. Now I want to go one step further than that, and I want to say, wow, the employer says, I want to do double bonus, I just don't want to pay for it.
Right, right. And that's the little more modern concept on this thing and why the solar concept is attractive. What it allows the employee to do, instead of the employer giving him a second cash bonus, he does a single bonus now, and to pay the taxes, the employee then borrows the cash from the contract to pay his taxes. Now there's all kinds of variations on a theme. The employer can say, hey, in our example, Steve, you're going to borrow and take it out, and you're going to accrue interest and have this loan, which is going to eat away at your cash. However, if you say stay for 5 or 10 years, or you're a loyal employee, at the end of it, instead of gold watch, I'm going to pay thousands and thousands of dollars to pay that interest off for you. And of course, you're going to have a bonus and be taxable on it, but I get a deduction. But we'll work that out so that you can get that loan paid off. If you vest in this restrictive endorsement and you can walk away, you may still leave all this money on the table for me to pay off this loan later on. And you can do that instead of the restrictive endorsement. You just forget the restrictive endorsement, simply say, hey, that's great, you can walk away, but you're going to lose what I promised you, that where I will pay off those loans for you on that contract so that you get all of the cash in that policy.
Well, when you think about it, you're approaching an employer who wants to tie down a key employee, an exec. What did you call him? A top hat guy. Yeah, I like that. And when I'm thinking about tying that person down, I'm thinking, okay, I'm willing to pay let's say in your example, I'm paying a $10,000 bonus into this life contract, but I don't want to pay on top of that the bonus. So inside this contract specifically, I can go ahead and help my key exec by saying we're going to fund the taxable event on my bonusing you out of the policy loans, and I don't have to wait 10 years. I'm doing it year one.
And let's talk about the icing on the cake. We talked about it in one of the earlier segments on the show. However, what's going on here is the employee, if they do that loan, still leaves the money potentially in the indexed account, and the cost of money may be potentially lower, and they make that spread. If the cost is 6% and they make 8%, they're getting a 200 basis point spread, and so that's that leverage we're talking about in the prior shows.
Yeah, when I think about the combination of businesses using indexed as a key recruitment tool, as a retaining tool, right, for key employees, and now having the policy carry some of the heavyweight here of having that bonus, because I don't have to pay the tax on it as the employer.
Well, and let's talk about another corporate aspect of it is in qualified plans, depending upon what they invest in, there's the potential of major losses in a given year. Okay, and while it's a cool benefit for the employee, they're not so happy about it anymore, are they? And the whole idea we put employee benefits is to keep the employees happy and staying with the company. Well, with an indexed account, yes, we can have a zero credited interest rate and we'll have costs against the contract, but I'll take that compared to what happened in 2008 all day long. So in terms of having employee incentives, we don't want to have a disincentive of a major market downturn that affects their outcome. This way, they may not have the upside potential, but they surely don't have the downside, the massive downside losses that are potential in a regular plan. So
yeah, I mean, when I measured the last 10 years, we did the last decade, 2001 to 2011, and I looked at the 4 negative S&P years, and I think nobody wants to take a hit, right? And people took massive hits in late 2007 and 2008. When I look at the numbers on the S&P 500, the loss in 2001, 2002, 2003, and 2008, and I look at those numbers, and I said the worst scenario was I had to pay about, in my contracts, remember I manage this, so not everybody can say what I'm about to say, but because I do managed death benefit, I buy the lowest possible death benefit to really manage the cost, switch when I need to do it, use the best policy loan scenarios. When I do that, even in those bad boy years, I would be telling a client expenses, current company expenses, all in, I might have blown maybe 250 to 280 in basis point loss. Now compare that to in 2008 and people losing a third of their retirement.
Or more.
Or more. So when I'm looking at this, it's not the catch-all, but if I wanted one part of my portfolio to be somewhat conservative, to be the bedrock of my thinking, to be foundational in my retirement plan, and part of that to make sure that I don't have to, if I can get away with it, I don't want to have it interfere with my Social Security benefits and getting that taxed. I love this combination.
Well, and let's not forget, there's life insurance thrown in that's part of those costs, and we can still use that for business purposes and family purposes as well.
Unbelievable. Well, remember, you can watch our show right on www.brokersalliance.com. That's the buzz on the biz for today. Get in the zone. The Business Insurance Zone.
The Biz is brought to you by Brokers Alliance. a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.